Welcome to the Deep Dive, where we cut through the noise and get straight to the impactful takeaways from the detailed research you've shared with us.
Today's topic is one of the most counterintuitive and frankly frightening concepts in all of macroeconomics.
I think so too. It's this idea that something that sounds wonderful on a personal level, falling prices, is often a signal that the entire financial system is, well, seizing up.
It is. We've analyzed your source material, and our mission for this deep dive is to get a really thorough understanding of deflation, what some have called the economic phantom that makes money too valuable.
Okay, so let's unpack that right away. Because if you walk into a store and everything is 10% cheaper than it was last year, my immediate gut instinct is, great, my money goes further. We're all hardwired to love sales.
Of course.
So why is deflation, where the general price level is actually decreasing and the inflation rate falls below zero, why is that considered such a huge red flag by central bankers all over the world?
That is the absolute core paradox we have to confront here. Deflation is a measurable increase in the real value of the monetary unit. So while inflation is constantly working to reduce the value of your currency...
Eating away at your savings.
Right, it's eating away at it. Deflation does the complete opposite. You can literally buy more goods next month than you can today with the same dollar. But, and this is the big but, this is where the macroeconomic nightmare begins.
Okay.
It means you have to sell more goods, or work more hours, or cut more costs to finance any payments that are fixed in nominal terms. And the big one there is always debt.
Okay, so let's make that concrete. If I'm a small business owner, maybe I sell T-shirts, and the price of my shirts is falling, let's say, 5% a year. But the payment I owe on the bank loan I took out last year, that dollar amount doesn't change.
It's fixed.
It's fixed. So suddenly, that mortgage payment or that business loan represents a much, much larger chunk of my actual revenue that I have to generate.
Exactly. You are paying back dollars that are, for lack of a better term, fatter or more valuable than the dollars you originally borrowed. And before we go any further, we really need to be crystal clear about the terminology here, because the media, well, it often gets this wrong.
Oh, yeah. Let's clarify. Deflation versus disinflation.
Disinflation is just a slowdown in the inflation rate. So if inflation was, say, 10% last year, and this year it's down to 3%, that's disinflation. Prices are still going up, just not as fast.
Still positive.
Still positive. Deflation means the rate is actually negative. The price index is falling, and that is the real danger zone.
Got it. So negative is the problem. This, I think, brings us to the central idea in the sources about deflationary shocks. I mean, is there any scenario where deflation is actually okay?
Well, the consensus among economists is that sudden, unexpected deflationary shocks are almost universally bad in a modern, debt-fueled economy.
Why is that? Is it all about the debt?
It's primarily about the massive, immediate increase in the real burden of debt, which acts like a profound brake on the entire economy. It severely aggravates recessions. It can lead to asset liquidation, mass unemployment. It basically sets up the conditions for what we call the deflationary spiral.
The spiral. We're going to be talking a lot about that, I imagine.
We are, and it is arguably one of the most destructive forces a leveraged economy can possibly face. We need to understand that this isn't just theory. The entire economic policy framework of the last, 90 years, from Keynesian stimulus to modern quantitative easing, is a direct result of trying to find ways to actively prevent this spiral from ever taking hold.
Because history shows it doesn't just fix itself.
It doesn't fix itself quickly enough, and the damage it does in the meantime can be catastrophic.
That sets the stage perfectly. So if the spiral is the scary destination, let's look at how we even get there. We're moving into the core mechanics now. How does this entire massive economic machine start tipping into a deflationary state in the first place?
Fundamentally, deflation happens when there's a persistent imbalance. An imbalance between the sheer volume of production and the amount of money available to actually buy that production. Or, just as importantly, how quickly that money is moving through the system.
The velocity of money.
Exactly. Your sources outline the general causes, which you can really boil down to three broad categories.
Okay, walk us through those fundamental drivers.
So first, you have high supply. This just means excess production relative to what people are actually demanding. If manufacturers, flood the market with cars or TVs, prices have to fall to clear that inventory.
Makes sense. Too much stuff.
Second, you've got low demand. This is the flip side. Consumption just decreases. Maybe it's due to fear, uncertainty about the future, a shock to household income like mass layoffs. People just stop buying things, and businesses have no choice but to cut prices to try and entice them back.
And the third one, you said it's often the most dangerous.
It is. The third is a decreased money supply, and this is usually driven by a credit crunch. Banks just stop lending. Or maybe careless investment leads to a flight of capital out of the country. I mean, if there's less money chasing the same amount of goods, the price of those goods has to fall.
Right. And you also see it caused by things like net capital outflow, some money leaving a country, or even just really intense competition forcing price wars.
All of those feed into it. They all disrupt that core balance.
I get the supply and demand side, but this is where that central paradox really hits me. The sources call it the learner's dilemma. If prices are falling, wouldn't the rational response for me as a consumer be to rush out and grab those bargains? Why does it cause consumption to stall?
Because consumers, when they're facing systemic deflation, are rational at the individual level. But their collective rationality leads to a completely irrational economic outcome. Think about it this way. If you're shopping for a new refrigerator today, and you are absolutely convinced that that same refrigerator will be 5% cheaper 6 months from now, what do?
I wait. 100%. Why wouldn't I?
You wait. And if millions of people wait on buying new cars, new equipment, real estate, durable goods, that simple, rational decision creates a massive collective problem.
It kills demand in the present.
It completely kills it. That waiting drastically reduces aggregate demand right now. This idles productive capacity, factories slow down, it reduces corporate investment because, well, future profits look bleak. And that reduction in demand then forces companies to drop their prices even further to try and sell anything at all.
That's terrifying.
Yeah.
It really is a self-fulfilling prophecy. My totally rational choice to save a few $100s by waiting becomes the very force that reduces my neighbor's income, which forces him to wait, and so on and so on.
Precisely. That is the engine of the vicious cycle. And this behavior, this waiting, leads directly to the problem of hoarding and what economists call the liquidity trap.
Okay, explain that connection for us. Why is deflation linked so closely to risk aversion and hoarding cash?
Because when money itself is increasing in value, when the cash under your mattress is actually yielding a positive real return just by sitting there, holding cash becomes an incredibly safe and, again, highly rational investment strategy for the individual.
So doing nothing is the best investment.
It becomes the safest and best investment. If you can get a guaranteed, say, 2 or 3% real return just by holding cash and waiting for prices to drop, why would you risk your money on a new factory, a new business, or a volatile stock market? The risk-reward calculation gets completely warped.
So the economy suffers a massive loss of faith in any kind of productive investment. Cash is king because cash itself is appreciating.
Correct. And this is what ties the central bank's hands. Their main tool, their primary lever, is lowering the short-term interest rate to incentivize borrowing and spending. But once that rate hits zero, they enter the dreaded liquidity trap.
They've run out of road.
They run out of road. The central bank can't normally charge a significantly negative interest rate on the cash that banks hold in their reserves.
Because people would just pull it out.
All right. They just pull it out physically. I mean, why keep your money in a bank that charges you for it when you can just stick it in a vault? It completely breaks the model.
So if the nominal interest rate is 0, but deflation is running at, say, 2%, the real interest rate, what borrowers are actually paying back in real terms, is still a positive 2%.
That's it. The central bank has run out of ammunition to make borrowing any cheaper. Zero interest often fails to stimulate the economy adequately because the real cost of debt remains stubbornly high.
And what about in a globalized world? Does that add another wrinkle?
It adds a huge wrinkle. In an open economy, this zero-rate environment encourages what's known as a carry trade. Investors borrow money at zero or near zero rates in the deflating country, let's say Japan, and then they invest it somewhere else, somewhere with a higher, safer return.
So the money just leaves the country that needs it most.
It flees. Now, this does devalue the deflating country's currency, which makes imports more expensive and can help a little with inflation. But it doesn't necessarily stimulate domestic exports enough to compensate for the overwhelming disincentive for people inside the country to spend or invest. The hoarding continues, and the economy just remains stuck in that trap.
Now that we really understand the mechanics of the spiral, let's explore how the sources categorize deflation. It seems it's not just one simple event, but there are, 6 distinct faces based on its root cause. We should probably start with the really strange one, the one that sounds almost good, growth deflation.
Yes, growth deflation is the ultimate paradox. It's really the only type that economists might not immediately panic about, though. While they still fundamentally prefer mild, positive inflation.
Why is it different?
This type is defined as an enduring decrease in the real cost of goods and services. And it's driven not by a collapse in demand, but by staggering technological progress and hyper-competition.
And the crucial difference here is the productivity gains are so enormous that they actually offset that impulse to delay purchases. Is that it?
That's the idea. People still buy because the goods are so much cheaper and so much better in quality than they were before. The supply curve just shifts outward massively.
Is there a historical example of this actually happening?
Oh, yes. The key historical example is the structural deflation that we saw from the 1870s right up until the major economic upswing that began around 1895.
What was going on then? What drove that specific episode?
It was the second industrial revolution. You had phenomenal gains in productivity from new mass manufacturing techniques, enormous economies of scale, and this is critical dramatically reduced transportation costs with the global expansion of railroads and steamships.
So it became cheaper to make things and cheaper to move them.
Massively cheaper. This led to oversupplied markets and constant competitive price cuts. An American economist, David A. Wells, writing in 1890, he documented this process extensively. He argued that the reduction in prices was directly attributable to these massive technology-driven efficiency improvements. It was a complete structural repricing of global commerce.
That makes perfect sense for that era, which was largely on a gold standard.
Yeah.
But your sources contrast this with the post-World War II era. We had incredible productivity gains in the 50s and 60s, but we didn't see deflation. Why the difference?
That's a critical insight for understanding modern policy. The 19th century economy was largely constrained by the gold standard. This meant the money supply was relatively rigid. It was tied to the physical stock of gold that a country held. So when productivity surged, those gains had nowhere to go but to drive prices down.
The amount of money was fixed, but the amount of stuff was exploding.
Exactly. But after the 1930s, and certainly after the world moved to fiat currency systems, central banks gained the flexibility to actively manage the money supply. So when productivity surged after WWII, central banks could and did expand the money supply enough to keep inflation positive, even if it was low. They prevented those cost cuts from ever tipping the economy into outright deflation.
So they deliberately target something like 2% inflation to give themselves a safety buffer.
That's precisely why they do it. It's a buffer against this deflationary risk. So growth deflation is possible, but modern policy is essentially designed to prevent it from becoming negative deflation.
Okay, that makes sense. Let's shift to the types that actively crash the system, starting with bank credit deflation.
This is a classic supply-side credit contraction. It happens when the supply of bank credit suddenly dries up. This can happen from a wave of mass bank failures, which literally removes money from circulation. Or, more often today, it's caused by a sudden, sharp increase in the perceived risk of defaults.
So banks just get scared to lend.
They get very scared. If banks believe that corporate loans or consumer mortgages won't be repaid, they immediately tighten their lending standards. They restrict credit. And since new credit is how the modern financial system generates new money, when that pipeline stops, the money supply contracts.
And that leads us logically to the most famous theory of all, debt deflation, which is, it's impossible to talk about without mentioning Irving Fisher.
Absolutely. The economist Irving Fisher developed this theory in 1933 while he was trying to make sense of the trauma of the Great Depression. His idea of debt deflation is associated with the end of massive long-term credit cycles. Think of the huge asset bubbles of the 1920s.
What's the core mechanism?
His theory states that when a massive credit bubble bursts, individuals, companies' attempts to pay down their debt at the same time in a desperate bid for solvency.
A mass deleveraging event.
Yes, and this mass effort to deleverage crushes spending. It reduces the velocity of money, and it forces fire sales of assets. People have to sell anything they can to get cash. These asset sales drive prices down across the board: stocks, real estate, commodities. The falling prices then increase the real burden of whatever debt is left, which forces more people to sell assets and liquidate, reinforcing that downward cycle.
That's another one of those vicious feedback loops.
Fisher called it the paradox of thrift, taken to its absolute extreme. The more everyone tries to save and pay down debt to fix their own situation, the worse the entire system gets.
That sounds like a powerful multiplier effect. Now let's look at this from the monetarist view, money supply side deflation.
Right. From a strict monetarist perspective, like Milton Friedman's, deflation is caused by one of two things: either a reduction in the total quantity of money supply per person, or a drop in the velocity of money.
And velocity is just how fast money is changing hands.
It's the rate at which money is exchanged from one transaction to another. If people get scared and stop spending, if they just hold onto their cash, velocity collapses.
The sources use the early U.S. experience before the Civil War to really illustrate that scarcity of money supply.
The early U.S. provides a powerful, tangible example of what an unstable money supply can do. Before 1862, the U.S. had no single national currency and suffered from a severe lack of physical coinage. The vast majority of commerce relied on banknotes issued by literally thousands of individual private banks. And the value of those notes, it depended entirely on the solvency of the bank that issued it.
A system built entirely on trust.
A very fragile trust. During financial panics like the ones in 1818 or 1837, banks would fail en masse. When a bank failed, its notes became either completely worthless or were heavily discounted by merchants relative to gold or silver. So this wasn't just a drop in velocity, it was a physical, measurable shrinking of the usable money supply, sometimes overnight. And that directly caused these steep deflationary periods as money became incredibly scarce and valuable.
That's a system where if faith is lost, the entire circulatory system just fails.
It does. And while modern central banking uses a far more complex definition of the money base, that historical inverse correlation is fascinating. Historically, a decrease in the monetary base sometimes led to an increase in money velocity as people raced to spend less valuable money. But in modern crises, we usually see the absolute worst-case scenario. Both the supply of money and its velocity drop at the same time, which just multiplies the deflationary force.
This brings us to credit deflation, which feels like the driver of most of the crises we've seen recently, and it's usually tied to central bank policy.
This is often the initial trigger. It starts when a central bank raises interest rates, maybe aggressively, to fight high inflation or to try and pop an asset bubble. In our modern high-leverage economy, that higher rate immediately slows down lending.
The cost of borrowing goes up.
It goes up. So less lending means less new money being created, confidence falls, velocity weakens, and aggregate demand just plummets. Businesses suddenly face a supply glut as all their buyers vanish, forcing them to slash prices.
And where does this become the true, undeniable spiral?
The spiral connection is reached when falling prices push businesses below their cost of production, or, critically, below the amount they need to service their debt. So they have to start liquidating assets. And the banks, which suddenly own all this foreclosed collateral homes, factories, equipment, they receive these dramatically devalued assets.
And if the banks try to sell them all at once,
they flood the market, which makes the deflation even worse. So the sources note that to prevent this glut and to, frankly, keep up appearances of solvency, banks in places like Japan, America during the 2008 crisis, and Spain, they often just withhold these non-performing assets from sale.
But that has its own consequences.
It does. It means they can't clear their balance sheets, which forces them to restrict new lending, which further kills demand. It's a paralyzing impasse.
This sounds strikingly similar to those U.S. 19th century financial cycles we talked about.
It is the exact same fundamental mechanism, just in different clothes. The sources detail how in the 19th century U.S., inflation and deflation correlated with these capital flows. Money was loaned heavily from the financial centers in the Northeast out to the commodity regions in the West and South. Prices would rise during the lending boom.
And then the crash would come.
When the panics hit like in 1818 and 1839, the banks in the Northeast would call in those loans sharply. That sudden systemic credit contraction caused commodity prices to crash, which directly triggered deflation.
And the Great Depression amplified this by adding that layer of global trade rigidity.
Precisely. The deflation of the Great Depression was caused by this massive overcapacity hitting an immovable wall of severely contracted demand. And it was amplified by huge global policy errors, like the Smoot-Hawley Tariff Act in the U.S., which just decimated international trade. It removed a crucial source of external demand and triggered the waves of bank failures and credit contraction that followed.
Okay, finally, we have a type of deflation that's externally imposed.
Right.
Currency pegs and monetary unions.
This one is crucial for understanding global economics today. If country A pegs its currency to country B, and country B has much higher productivity growth, country A suddenly becomes uncompetitive. Its prices are relatively too high.
And since they can't devalue their currency because of the peg,
they have to adjust internally.
So if they can't change the exchange rate, they're forced to change their internal costs.
Yes. They must lower their factor prices. That means wages, rent, and other internal production costs have to come down to maintain competitiveness. Cutting wages and input costs fosters a deflationary environment domestically. It's a very painful process required to stay aligned with the foreign currency. We saw this exact mechanism play out across certain Eurozone member states after 2008 and in Hong Kong after the Asian financial crisis. They are, in effect, importing deflation by fixing their exchange rate to a stronger, more productive currency bloc.
Now that we've locked down the how of deflation, let's pivot to the catastrophic what happens next, the actual economic consequences. The sources really stress that the pain of deflation centers squarely on the borrower.
It does, because deflation is truly welcome only in a system with very little debt. And since modern economies are fundamentally debt-driven, deflation amplifies what the sources call the sting of debt. When prices are falling, every future debt payment represents a greater amount of real purchasing power than it did when you originally took out that debt.
Let's use that specific example from the sources to make this really tangible. If deflation is averaging 10% a year, which it did during the worst period of the Great Depression, what does that actually do to an ordinary loan?
It makes that loan absolutely toxic. A 10% annual deflation rate meant that even if a bank offered you a loan with 0% interest,
An interest-free loan.
an interest-free loan, you were still paying back money that was effectively 10% more valuable each year.
Hmm.
That is a 10% real interest rate, regardless of the nominal rate written on the paper. And that realization just freezes lending, it kills all economic activity, and it pushes otherwise solvent businesses into insolvency.
Wow, that really changes the way I think about credit. Even a zero nominal rate is incredibly expensive in that environment. And this circles us back perfectly to the zero bound problem.
It does. When central banks hit that zero lower bound on short-term nominal interest rates, they've exhausted their conventional means of easing policy. Deflation then guarantees that the real interest rate, the rate that truly matters to borrowers, remains significantly positive. It keeps debt servicing difficult, and it actively restricts new investment.
So monetary policy just stops working.
It stops working. And this is why, during severe deflation, political and fiscal measures, particularly debt restructuring or massive government spending, become the only tools left in the toolbox.
Okay, let's look at the flip side. Savings and investment. We talked about hoarding cash, but how does deflation specifically discourage productive investment, even if the cost of capital is near zero?
It's purely about the expectation of future profit. Investment is all about betting capital today on future returns. So if I, as a factory owner, anticipate that the widgets I produce next year will sell for 3% less than they do today, the incentive to borrow money, buy new equipment, and expand my capacity just evaporates.
Why bother?
Why bother? The net return on my investment is being eroded by guaranteed falling prices. And this results in a pervasive discouragement of private investment across the entire economy and a catastrophic collapse in aggregate demand.
And as you said, holding money is actively rewarded.
It is. This is the behavior that mainstream economists find so dangerous. While the Austrian school might see some deflation as a necessary correction of malinvestment, the vast majority of economists agree with that. Quote, your source is provided from Friedrich Hayek. He said, it is agreed that hoarding money is deflationary in its effects. No one thinks that deflation is in itself desirable.
So even a libertarian champion of free markets acknowledged that this psychological incentive to hoard cash just destroys the economy's circulatory system.
He did. It paralyzes everything.
The sources make a very sharp distinction between the effects of deflation and its opposite, inflation, specifically on wealth transfer. This feels like a crucial nugget of knowledge for our listeners.
This is the ultimate differentiator that determines who wins and who loses. Deflation transfers wealth from borrowers and holders of illiquid assets, think farmers with mortgaged land or factory owners with heavy equipment, to savers and holders of liquid assets or currency. The system rewards holding cash. The inevitable consequence is generalized underinvestment.
And inflation just completely flips that transfer on its head.
Absolutely. Inflation transfers wealth from currency holders and lenders, the savers to borrowers, including governments who borrow vast sums of money. The system rewards spending immediately. The consequence of prolonged high inflation is often overinvestment, where capital floods into low-quality projects, creating bubbles like the dot-com boom or the housing crisis, because everyone is desperate to buy something, anything, before their currency loses more value.
So, to put it simply, deflation leads to stagnation and underinvestment, and inflation leads to asset bubbles and malinvestment. Both are destructive, but in fundamentally different ways.
Correct. And that's why, when we look back through history, prolonged severe deflation is almost always associated with major economic depressions like the Great Depression or the late 19th century Long Depression.
Okay, let's just zoom in on the spiral itself one final time to make sure we have fully grasped that positive feedback loop.
Think of it as a chain reaction. It might begin with price drops, maybe due to a credit contraction. These price drops immediately cut into corporate profit margins, forcing companies to engage in lower production or even liquidation.
Which means layoffs.
Which means layoffs. Lower production and liquidation mean job losses, which translates directly into lower wages and lower consumer confidence. Lower wages and less demand then guarantee further price drops, which starts the entire cycle over again, but from a lower base. It is a runaway system where the economic depression itself becomes the fuel for an even deeper depression.
And this is where Irving Fisher's theory really bites.
Precisely. That feedback loop is exactly why his theory, that a mass attempt to repay debt triggers a price collapse, which then increases the real burden of the remaining debt, is so terrifying. It means the very act of trying to fix your individual financial problem makes the collective disaster worse.
If deflation is this structurally destructive, especially in a society as leveraged as ours, then fighting it becomes the absolute top priority for central banks and governments. How did policymakers go from this old belief that the system would just fix itself to developing these modern, almost outlandish tools like QE?
There was a dramatic intellectual shift, and it really started in the 1930s. Before that decade, the prevailing classical economic view was that deflation, while painful, was temporary and self-correcting.
What was their logic?
They believed falling prices would eventually increase the real wealth of savers, who would then feel richer and spend more. They also thought cheaper goods would naturally boost demand and the economy would stabilize without any external help. It was a very hands-off, weighted-out approach.
But the sheer persistence and depth of the Great Depression clearly shattered that belief.
It completely shattered it. John Maynard Keynes famously argued that the system is not self-correcting when you're in a liquidity trap. Therefore, governments and central banks have an obligation to actively intervene to boost demand.
So he was arguing for an active approach.
Very active. The Keynesian prescription involved fiscal tools, aggressive tax cuts or massive increases in government spending, often through public works and infrastructure projects. At the same time, the emerging monetarist school, led later by Milton Friedman, focused on monetary tools, aggressively expanding demand by lowering interest rates to reduce the cost of money and force cash out of hoarding.
Okay, so let's talk about the modern playbook. When nominal rates hit that zero lower bound, or ZLB, conventional easing is impossible. What are the special arrangements that are required to overcome that ZLB and force the money supply to increase?
This is where it gets really unconventional. The central bank finds itself unable to lower the price of money any further, so they have to switch tactics and focus on the quantity of money. They require these extraordinary policy measures to just flood the system with liquidity, even at a zero nominal rate, knowing that the real rate is still high because of the deflation. They are essentially trying to manufacture inflation expectations.
And this is where the term quantitative easing, or QE, becomes the dominant phrase in finance.
QE is the primary modern weapon against persistent deflation. It's fundamentally the central bank directly setting a target for the quantity of money and reserves in the banking system. And they achieve this by purchasing financial assets, and crucially, assets that are usually not used as bank reserves, like long-term government bonds or even mortgage-backed securities.
So they're not just lending to banks, they're actively buying assets from them.
Exactly. They're trying to inject massive amounts of liquidity directly into the financial system.
Help us break down the mechanism of QE. I mean, it sounds complex, but if the goal is to create inflation, how does buying a bunch of mortgages from a bank achieve that?
It's a massive asset swap. The central bank takes these slow, illiquid assets, like mortgage-backed securities, off the commercial bank's books and replaces them with pure cash in the form of bank reserves. The theory is twofold.
Okay.
First, by buying all these long-term bonds, they force long-term interest rates down across the entire economy, which should make investment marginally cheaper. Second, they pump the banks so full of cash that the hope is the banks will eventually be forced to lend that cash out into the real economy. That increases the money supply, increases velocity, and thus creates inflation.
The ultimate belief seems to be that money, or printing money, is powerful enough to overcome any economic hurdle.
That view was definitively captured by the former Federal Reserve Chairman Ben Bernanke. Back in 2002, he was referencing the Great Depression, and he stated unequivocally that, and I'm quoting here, sufficient injections of money will ultimately always reverse a deflation. The core idea is that the power of the printing press is limitless, and if you print enough, you can always spark demand and confidence.
But the sources introduce some pretty significant and valid criticisms of this idea. This hasn't always been the silver bullet that was promised, has it?
Not at all. And that's the nuance that the listener really needs to grasp. We saw that these accommodative policies largely failed to spur sufficient demand in Japan throughout the 1990s and early 2000s, and to some extent in the US following the dot-com stock market shock. You can flood the banks with reserves, but that doesn't guarantee lending if the banks themselves remain risk-averse, or if companies simply lack profitable investment opportunities. You can lead a horse to water.
But you can't make it drink.
Precisely. Furthermore, we have to address the critique raised by Austrian school economists. They contend that sustained low real interest rates, even zero nominal rates, artificially stimulate asset speculation and excessive debt accumulation in the non-financial sector.
So they'd argue QE isn't solving the problem.
From their perspective, QE isn't fixing the underlying debt problem at all. It's merely papering over it and potentially aggravating a more severe debt deflation crisis that's waiting to happen when those new asset bubbles inevitably pop.
So rather than fixing the fever, they're just delaying the inevitable systemic correction.
That is the core of their critique. And finally, let's just mention the truly experimental tool that was deployed after 2008, negative interest rates.
That sounds like something out of science fiction. How does a bank literally charge you to hold your money?
The idea is to make holding cash in bank reserves actively punitive. The central bank charges commercial banks a small percentage for parking their reserves with them. This is meant to force those banks to lend the money out, to do something with it, to accelerate velocity.
Is there a limit to that?
There's a very firm limit. The rate cannot go too negative, maybe only a fraction of a percent, because if it does, people and corporations will simply withdraw their deposits as physical cash and hoard it in vaults. And that would completely nullify the central bank's efforts and trigger a whole new form of money supply contraction.
We've established the theories and the tools. Now, let's ground all this knowledge in the great historical case studies provided in the sources, starting with the U.S. experience, where deflation was essentially a regular feature of economic life before the Federal Reserve was created.
Indeed. The U.S. faced multiple severe deflationary episodes. The Depression of 1818 to 1821 is often considered one of the most severe, at least in terms of the price collapse. Agricultural commodity prices, especially cotton, fell by nearly 50% in just a few years.
50%. What were the catalysts for such an extreme drop?
It was a combination of global and local factors. Globally, a financial crisis in England caused a credit contraction that began draining hard currency specie, gold and silver, out of the U.S. Locally, the newly operating Bank of the United States significantly reduced its lending. The result was a classic, sharp credit contraction.
And there was a food price element too, wasn't there?
There was. Prices for food crops had been artificially inflated because of the global famine caused by the 1816 year without a summer eruption of Mount Tambora. Once normal harvests returned in 1818, prices just crashed back to earth.
And technology played a role even back then.
It did. Crucially, improved transportation, early turnpikes, and steamboats played a deflationary role. By dramatically lowering the cost of moving goods to market, this introduced a structural, productivity-driven price decrease. So this episode was really a mix of credit deflation and a very early form of growth deflation.
Okay, next up, the Depression of the late 1830s to 1843. This one looks terrifying on paper.
It was incredibly severe. Following the Panic of 1837, the currency in the United States contracted by about 34%, and prices fell by a matching 33%. That's a scale comparable only to what happened during the Great Depression decades later. The causes included a banking crisis, state bond defaults, and British banks cutting off the flow of specie after the collapse of the cotton market.
A contraction of that magnitude sounds like a total societal collapse. Did output also collapse by a third?
And this is the absolute key nuance that prevents us from equating all deflationary periods. Despite the severe monetary contraction and the price falls, U.S. GDP actually rose by 16% between 1839 and 1843.
Wait, how is that possible? How can you have a severe depression and deflation and a massive 16% rise in output at the same time?
It suggests that the productivity gains, the underlying economic machine, were just powerful enough to partially offset the financial contraction. So while borrowers and speculators were facing ruin, essential production, particularly in agriculture with new cropland coming online, continued to grow. This made goods cheaper and more abundant, even as the money available to buy them was shrinking.
So it was a financial depression, but not necessarily a production depression.
That's a good way to put it. And it makes the 1830s depression fundamentally different from the Great Depression, where the financial and production collapses were very tightly coupled.
That contrast is an incredible insight for our listener. Okay, let's move to the Great Deflation, spanning 1873 to 1896.
This was a truly global event, known in some parts of Europe as the Long Depression. Structurally, it was rooted in the return to the gold standard and the retirement of all that Civil War paper money. But its defining feature was technological. It was a massive wave of cost-cutting and productivity-enhancing technologies. Bessemer steel, transcontinental railways, the telegraph.
So this was slow and steady deflation.
Very steady. According to Milton Friedman's analysis, prices in the U.S. fell by a steady 1.7% per year during this entire 23-year period. It was slow, it was persistent, and it was overwhelmingly technology-driven.
This sounds like the purest form of growth deflation we discussed earlier. Did that productivity impact all goods equally?
No, and that's the nuance that David A. Wells provided back in 1890. He argued that the deflation only really impacted goods that benefited from these modern manufacturing and transportation methods. Goods produced by, say, local craftsmen or localized services did not see the same price decreases.
What about wages?
Even more telling. The cost of labor wages actually increased in real terms because of the overall prosperity and productivity gains. This reinforces the idea that it was technology and efficient scale driving prices down, not purely a crushing lack of demand.
And finally, we have to touch on the Great Depression deflation of 1930 to 1933. That changed all the rules.
This was catastrophic, with a deflation rate hitting approximately 10% per year. The mechanisms were a brutal combination of every bad type of deflation we've discussed. There was an enormous contraction of credit, widespread bank failures, and a frantic psychological demand for cash.
And the central bank made it worse.
The Federal Reserve, operating under a mistaken doctrine, actually contracted the money supply by 30% when it should have been massively expanding it. The simultaneous, profound drop in both the money supply and its velocity created the perfect, inescapable spiral.
Before we move to the modern era, let's quickly acknowledge the brief, recent dips into deflation in the U.S.
Right. In the past 60 years, deflation has only occurred twice, and very briefly. In 2009, during the Great Recession, the U.S. saw measurable deflation, hitting Natico's 2.1% year-over-year in July. This was driven by the collapse in energy prices and housing demand.
And that led to that interesting policy footnote in Colorado.
Yes, where the state actually announced a cut in its minimum wage because it was indexed to inflation and inflation had gone negative. That was the first time a state had done that since 1938. And then we saw another minor short-lived dip to manageable 0.1% in 2015, which was mainly driven by global oil price crashes.
Okay, now let's turn to the ultimate modern laboratory for fighting deflation, Japan's lost decades. This is the cautionary tale for central bankers everywhere.
Japan's experience, starting in the early 1990s, showed that monetary tools that work perfectly in theory often fail completely in practice. Deflation persisted for decades despite the Bank of Japan implementing a zero interest rate policy, or ZRRP, and conducting extensive rounds of quantitative easing. Their accommodative policies simply failed to generate a sustained increase in the broad money supply or its velocity.
What were the specific systemic issues that made the deflation so utterly stubborn?
Well, there were at least 7 interlinked structural causes. First, believe it or not, tight monetary conditions. Ironically, the Bank of Japan frequently tightened policy, even just marginally, whenever deflation seemed to be ending. They were so terrified of a return to the asset bubble of the 80s that they effectively short-circuited every nascent recovery.
And demographics played a role.
A huge role. Second, unfavorable demographics. Japan has a rapidly aging and declining population, which inherently constrains long-term aggregate demand, regardless of what interest rates are. Third, fallen asset prices. The spectacular stock and real estate bubble of the 1980s burst, leading to a painful asset price deflation that required decades of mean reversion, which just depressed confidence for a generation.
This leads to the famous issue of zombie companies and the paralysis in the banking system. That's a key piece of regulatory insight from the sources.
Absolutely crucial. Fourth, insolvent or zombie companies. Instead of forcing immediate liquidation, Japanese banks, often with implicit regulatory approval, just delayed collecting on non-performing loans. They were hoping that the assets would eventually recover. They kept these unrealized losses on their books.
And what did that do to the broader economy?
It allowed these non-productive insolvent firms, the zombies, to just keep existing. It prevented capital and labor from moving to more productive sectors, which just perpetuated the deflationary stagnation.
And the banks themselves are in trouble.
Yes. Fifth, the banks themselves became insolvent banks. With these huge portfolios of non-performing loans, they couldn't lend new money. They were forced to just build up their cash reserves to cover the bad loans, which further restricted the credit supply.
And the public responded rationally to this bank fragility, I assume.
They did. That's the sixth point. Fear of bank collapse. The Japanese public, seeing the banking system struggle, preferred buying extremely safe Japanese treasury bonds instead of putting their money in bank accounts. This money was locked away from the lending system, depressing both consumption and new investment. The public was hoarding bonds, not cash, but the effect was basically the same.
And the seventh factor.
Seventh, Japan faced imported deflation. As countries like China industrialized rapidly, Japan was importing increasingly cheap consumable goods. Domestic producers were forced to cut their own prices to remain competitive, which created a powerful external deflationary force that monetary policy couldn't easily counteract.
Finally, what about the massive fiscal response? I mean, Japan spent an enormous amount of money on stimulus packages.
They did. But the sources mention the Austrian and monetarist critique that Japan's massive Keynesian stimulus packages, totaling over 100 trillion yen over the years, may have actually suppressed private wealth creation. The argument is that the government, by spending so heavily on public works, was competing against and crowding out private investment dollars, thereby hindering the natural, productive reallocation of capital that the economy so desperately needed.
And it remains a problem to this day.
It does. Despite Prime Minister Shinzo Abe's policies finally achieving some inflation by 2014, the subsequent COVID-19 recession reignited deflation fears in 2020. This prompted heavy government stimulus worth over 20% of GDP. Japan remains the classic example of how entrenched structural deflation can resist even the most aggressive monetary action.
Let's briefly touch on those examples of deflation caused by currency rigidity, starting with Hong Kong.
Hong Kong provides a perfect lesson on the constraints of fixed exchange rates. Following the 1997 Asian financial crisis, most of Hong Kong's neighbors devalued their currencies, which helped their recovery. But Hong Kong maintained its firm peg to the US dollar, which prevented devaluation.
So they were forced to adjust internally.
They had no choice. To maintain competitiveness against their devaluing neighbors, Hong Kong had to go through a prolonged period of consumer price deflation that lasted until late 2004. This internal deflation was worsened by cheap mainland Chinese exports and actually created a slump that was more severe than in many surrounding countries.
And we saw this same internal adjustment pressure inside the Eurozone.
Yes, specifically between 2013 and 2016, several Eurozone members, Greece, Cyprus, Spain, and Slovakia, and countries pegged to the euro, like Bulgaria, they all experienced periods of negative inflation. Because they shared a common currency or were pegged to it, they couldn't use devaluation to stimulate their trade. They were forced into that same painful process of internal adjustment cutting wages and prices to try and restore competitiveness within the monetary union. They were essentially importing deflation to align with the more productive members, like Germany.
And that intriguing outlier example from Ireland in 2009.
That was a rare moment of political honesty. When Ireland announced its first annual negative inflation since 1960, the finance minister, Brian Lenihan, actually mentioned deflation as a factor that supported the argument for budget cuts to public sector pay and child benefits.
So he used it as a justification for austerity.
He did. Instead of treating deflation as a sickness to be avoided at all costs, he treated it as data that justified the painful but necessary wage cuts needed for that internal adjustment. It's a pragmatic, if painful, response to fixed currency realities that you rarely hear voiced so explicitly by modern Western policymakers.
This has truly been a comprehensive deep dive into deflation. It's absolutely clear that this concept is far more complex than just a simple sales sign in a shop window. Let's bring this all back to the essential takeaway for the listener.
The essential takeaway is that deflation is not merely a sign of falling prices, it is a profound structural crisis. It's rooted in the corrosive relationship between massive debt loads and the financial system's inability to generate money velocity. In a modern, leveraged economy, deflation dramatically increases the real cost of every single loan, and it completely destroys the psychological incentive to undertake productive investment. And that is why central bankers see low positive inflation as mandatory economic lubrication.
We've established that the primary tools of the last 90 years, Keynesian fiscal stimulus, ZRRP, and quantitative easing, were engineered primarily to fight credit deflation, the kind that follows debt bubbles and monetary contraction. But let's look forward and maybe a little bit back to the 19th century. We saw those periods of powerful growth deflation that were driven by unprecedented technological leaps.
The question we face now is whether history is cyclical. If future technology, perhaps advanced automation, AI-driven efficiencies, or even breakthroughs in materials science, if that technology dramatically cuts the cost of production across all sectors, does that 19th century phenomenon of growth deflation become structurally inevitable once again?
And that raises a really important question for you to mull over. If we enter a sustained era where technology drives prices down year after year, are our current monetary policy tools, which all rely on increasing the money supply to counteract a failure of demand, are they even equipped to handle a future deflationary environment that's driven not by economic depression or debt, but purely by staggering, relentless productivity gains?
Will we need entirely new tools to manage an economy of prosperity that costs less and less to achieve?
Something to consider as you observe the price of your next durable good purchase. Thank you for joining us for this deep dive.
We'll see you next time.